Right now, there's a dollar amount written into federal law that quietly hovers over every checking account in the country. Cross that line, even once, and your bank hits a switch. A report shoots off to a federal agency, no calls, no warning, you're not even notified. It happens automatically. But honestly, the report itself isn't what you should be worried about. The real danger comes in what people do once they hear about it. There's this knee-jerk move that seems harmless, but it's actually a federal felony. I'm Lana Maines, and I dig into these hidden rules every week so you can protect your money. Rules that no one hands you a manual for. If you want your finances to work for you, you'll want to stick around and subscribe because there's a lot more coming. Let's get specific. The Bank Secrecy Act of 1970 says every single financial institution, big banks, credit unions, savings and loans, is legally required to file a currency transaction report, CTR, with FinCEN, the Financial Crimes Enforcement Network, anytime someone makes a cash transaction over $10,000 on a single business day. That means cash, not checks you write or typical direct deposits, but physical bills and sometimes money orders or cashier's checks. All your personal details, your name, social, date of birth, home address, amount, and exact time, get packed into FinCEN Form 104 and sent along. The bank has 2 weeks to file it, and you'll never see it. In fact, they can't tell you they did it. They're legally on the hook to stay silent thanks to 31 United States Code Section 5313. Here's where it trips people up. This isn't about that $2,000 direct deposit or a payroll check. Everyday electronic transfers slide right past this law. The focus is on physical cash. And if you deposit $5,000 at one branch and $6,000 at another branch on the same day, that's $11,000 in your bank's eyes. You can't get around it by splitting up which branch you use. But let's talk reality. Most folks just never touch $10,000 at once, and retirees might feel safe because of it. But that sense of security is a little misleading, and if you've got meaningful savings, or you're consolidating accounts, getting a final pension payout, or handling disbursements after someone passes, you're actually more likely to pop up on their radar. These reports aren't accusations. Most CTRs don't trigger a thing, they're just paperwork. Millions go through each year, almost all go nowhere. Still, the problem isn't the CTR, it's what comes next. And here's the part almost nobody tells you. $10,000 isn't even the number you should care about most. Banks file another kind of report called a Suspicious Activity Report, or SAR, and guess what? There's no dollar minimum. This isn't about huge sums. A SAR can flag a $2,000 deposit or a few $100 if your pattern of transactions looks off to their computers. And the fastest way to trigger a SAR? Making a series of deposits that, if combined, would be over $10,000, especially if they look like you're trying to sidestep that reporting threshold. Think about Diane, a 67-year-old retired nurse near Nashville. She sold her car for $11,000 cash, thanks to a buyer who couldn't get a cashier's check that day. Diane had heard $10,000 was some sort of line, so she deposited $5,000 on Tuesday and $6,000 on Friday. 2 visits, her money, a legal sale, no big deal, right? But Diane's bank, noticing 2 big deposits in quick succession into an account that usually held less than $3,000, filed a SAR. Diane did absolutely nothing wrong, but that report now tags her in a federal database, cross-referenced with anything financial she does in the future. Here's the kicker. Banks are forbidden from telling you if they file a SAR. A bank employee who tips you off. That's a felony. Tipping off. And someone could go to prison for it. The law intentionally keeps you in the dark. Now here's where people really stumble. When folks hear about the $10,000 threshold, their first instinct is always the same. Keep every deposit under the limit. Maybe split up the sum a bit each week. It feels like a simple workaround, but it's not. That's called structuring, and it's a federal crime, whether you're handling clean money or not. Break a big deposit into smaller chunks on purpose just to avoid a CTR, and you've just committed a felony. The punishment is harsh, up to 5 years in federal prison and a $250,000 fine for less than $100,000 in a year, up to 10 years if it's more. The government can grab your money through civil asset forfeiture before any conviction, and now you have to prove it was all legal. While you work to clear your name, your money is already gone. And this isn't some rare theoretical risk. Federal watchdogs found that 90% of structuring seizures actually hit normal people handling perfectly legal money. The law was designed for drug dealers and launderers, but in practice, the system mostly flagged regular account holders. There was enough outrage that by 2015, the IRS said they'd stop seizing legally sourced money in most cases, and in 2019, Congress said structuring alone, when money comes from a legal source, isn't enough for the IRS to seize your funds. But that just limits the IRS. Structuring is still on the books, and the Justice Department can still go after you. The lesson stands. Never break up a big transaction to cross under the threshold. The most common people caught up in this are retirees. Why? They don't usually get regular paychecks anymore. Instead, they get lump sums from a pension, an inheritance, a car or house sale, a life insurance payout, or retroactive Social Security. These aren't crime flags. They're just normal life events landing as big, odd transactions. Exactly the thing the compliance software is built to pounce on. And unlike back when they were earning a salary, retirees are less likely to have an accountant or financial advisor keeping an eye out for issues, so these things often snowball before anyone realizes. One more layer to this. The Bank Secrecy Act started in 1970 to fight money launderers and organized crime, and after 9/11, it was expanded under the Patriot Act to catch terrorist funding. The computer doesn't care if you're moving dirty money or transferring your nest egg. The pattern of big, irregular deposits looks the same without context. That's why the most powerful shield you have is documentation. When authorities see a CTR, they don't come knocking unless there's some other red flag. But if questions come up, you want a paper trail ready. So, what should you actually do? First, know that you might be missing out on all kinds of programs, exemptions, and refunds that you qualify for, but never claim. I've pulled together every state-by-state break and form for seniors, the Senior Exemption Playbook, so you can find exactly what applies to you without wasting hours on government websites. It's all in the first pinned comment. Seriously, don't leave money on the table. But here's the heart of your protection: transparency and documentation, not secrecy or avoidance. Take Sylvia, a 71-year-old former school principal in Baton Rouge. She inherited $38,000 from her brother's estate. She went to her bank, deposited all of it at once, handed the teller copies of the estate paperwork and the will, and asked the teller to note the source. The bank filed a CTR, and that's it. No drama, no questions, because she had her documentation and made things easy for everyone involved. This is your action plan, laid out step by step. 1. Before depositing any large sum, gather the document that proves where it came from: bill of sale, estate letter, gift letter, pension notice, whatever applies. 2. Deposit the full amount in one shot, not spread over days or branches. 3. Hand your proof to the teller and ask them to note it on your transaction. They can, and you're well within your rights to request this. 4. Keep a personal, physical, or digital file of every supporting document for any transaction over $5,000. 5. If you're transferring money between your own accounts, do it as a single wire with a memo line and save statements from both ends showing the same-day transfer. 6. And most important, never, under any circumstance, break up a deposit or withdrawal just to duck the $10,000 trigger. Legitimate large transactions are fine, and trying to hide them is the only thing that causes real trouble. Let's talk about how you manage your money day to day, because this alone can keep your accounts clean and lower the odds of getting flagged. Your checking account isn't a vault, it's your wallet. It should only hold what you need for a couple months of expenses and a small cushion. Move your emergency fund, 3 to 6 months worth, into a high-yield savings or money market account. Must be FDIC insured. This stash earns interest, fights inflation, and doesn't clutter your daily banking. Anything you won't touch for a year or more? Short-term Treasury bills or CDs, let it work even harder for you. This setup also protects you from the slow drain of inflation and keeps big, irregular transactions out of your main checking, so there's less that looks weird to the computer. A tip for retirees. If you have to take required minimum distributions from retirement accounts, spread those withdrawals smoothly over the year, rather than dropping a lump sum in December. That's planning, not structuring, and it reads completely differently on a bank compliance report. Gifts between family members matter here too. There's a $19,000 annual exclusion per person in 2026 for gifts before any gift tax paperwork needs to be filed. But over that, Form 709 kicks in. You usually won't owe real taxes, but you need to record the transaction. A simple written note protects you if a question ever comes up. Here's an extra pitfall. A big retirement withdrawal or inheritance can push a chunk of your Social Security into taxable territory and might quietly increase your Medicare premiums 2 years down the line through IRMAA. No one tells you until the bill comes, so if you can, split those events across tax years to smooth out the bite. And if you're using apps like Venmo, PayPal, Zelle, or Cash App, keep them organized. Money from side hustles, sales, or family sometimes blends into the same account monitored by the bank's systems. That doesn't mean stop using digital payments. Just make sure you're ready with records if any questions ever pop up. Quick recap. Collect source documents before any big deposit. Deposit the total at once. Don't split it. Give proof to your teller and ask for a note on the transaction. Keep records for anything over $5,000 just in case. If you're moving your own money around, make it a single, well-documented transfer. Never split deposits or withdrawals to avoid a federal trigger. And before you even consider turning to cash stashed at home, don't. It isn't insured, disappears in a fire or theft, is tough to explain if ever questioned, and loses value to inflation over time. The solution is never secrecy. It's smart structure and clear records. Banks won't explain this, and when things go sideways, they're not allowed to tip you off. But you can go in ready, organized, protected, and in control. That's what keeps your money safe in a system where software doesn't know the difference between a retiree and a criminal, unless you show it.